Morning, morning, morning. All right, let's go. I'm going to talk today about a fundamental shift. I think we've got a generational shift going on from a low inflation, low interest rate environment to a high inflation, high interest rate environment, which is not a cyclical thing, it's a systematic thing. I'll come back onto that. And that's part of the reason the markets are so jittery at the moment. So we've had, for the first 6 months of this year, the worst start to the year since 1970. Feels pretty bad. And I know clients are upset and emotional, and it's very difficult when you may be embarking on a little bit of a bear market. That could be happening. And if you look at the stats, the first half, the US is down 20%, global is down 20%. NASDAQ down, can you see? Down 30%. And even bonds are down 10%. These are all global numbers in US dollars. So if you're a balanced fund, you're having a tough time. SA held up a little bit better. See, we'll talk about that a bit later. So South Africa, where we've been overweight, thankfully, fell by less, slightly less painful than the rest of the world. So if you wanted to hide, you wanted to be in commodities or oil particularly. Oil is up, give or take, 50% in the first half. Dear old Bitcoin, we've talked a lot about crypto. We can deal with that later if you like. Crypto is down 56%. I did say we'd have an opportunity to buy this thing. This may be it. Not for the faint-hearted. And your safe haven was gold. Again, we've talked about that in the past as well. So a tough first half, and this is why. Look at this chart back to, okay, 1960. This is inflation in the light blue and the Fed funds rate, interest rates in the dark blue. If you go back to 1980, in light blue, inflation was the unimaginable 14.5% in the States. It's currently about 10 or 11% in many countries. We'll come back onto that. And what did Paul Volcker do, the chairman of the Fed, in 1979, 1980? He hiked rates to 18.5%. Okay? Interest rates in the States today are 1.5%. Look at inflation today. 8.5%, 9% in the States. Interest rates 1.5%. To beat inflation, you have to have rates above to beat inflation, you have to have interest rates above inflation. You have to have positive real interest rates. Now, I'm not saying we're going back to an environment of 10% interest rates, I don't think. But we're heading to interest rates much higher than they are today. Probably higher still than the market thinks. And if you're in technology, then all these speculative areas of the market where there was hope for the future in terms of longer-term earnings and profits coming through further down the line, think Peloton, then this is the Morgan Stanley Unprofitable Tech Index. Okay? So those companies which are unprofitable today, and there's lots of hope for tomorrow, way down the line. For that, you need low interest rates, because your profits are coming a long way down the line, so you've got to discount them back at a low rate. Discount back at the high rate, that's a problem. So tech got crushed, so down 64% if you're unprofitable. NASDAQ down 28%. So it's been a really tough shakeout. And again, we talked about this probably the middle of last year, throughout the first half of last year. We were going to see a shakeout in technology, in the speculative areas of the market as rates rose. And that is happening now. But here's the kind of a little bit of the hope bit. Don't stress too much, okay? Because bear markets don't last forever, and they generally don't last that long. This is quite an interesting chart. If you go back to 1933, the blue kind of areas are your bull markets, and your red areas are your bear markets. So at a glance, you can see bull markets last for quite a long time. So the market goes up kind of slowly for many years, and then drops very sharply. And the bull markets last a long time, and they have a very large extent to them. So the market tends to go up a lot more than it goes down. So for long periods of time, you want to be in the market. At the moment, we're down 23%. It's been half a year. I don't think we've quite seen the bottom yet, actually. The market is very jittery. What day is it today? Tuesday. Thursday, President Putin may turn the gas off full time into Germany and Europe. That could, if I was him, that's what I would do, actually. That's going to be a big problem. So we have lots of uncertainty in the markets, lots of hurdles to overcome. So we may not have quite seen the bottom, but over the very long term, you need to stick with it. Part of the story in markets right now is that the valuation of markets, which we've been saying has been very high, has come down a lot. So again, that gives you a little bit of comfort. This is the price-earnings ratio for the S&P. Where are we? It was kind of 16 times COVID time. It got up to 36 times. 36 times earnings. That is a high price-earnings ratio at the peak. That has come down all the way back to 18 times. More like it's kind of long-term-ish norms. It's not probably bottoming out, but again, a lot of froth's come out of the market. So that gives you a little bit of comfort. And we mustn't forget the long-term picture. You can look at this chart, and while you digest it, you can either take great comfort or you can take great dread from this chart, okay? You can take either. It's up to you. This goes back to 1870. The comfort bit is that markets go up a lot over long periods of time. This is a logarithmic scale, so many-fold increases in the market over long periods of time. So that's the upward sloping line. The kind of, if you want to be worried about lifeline, is that we tend to get kind of flat decades. So you can see post the Great Depression, flat. That was the 1970s here. Inflation, Vietnam War, to come back onto that. Lost decades. So we may have a bit of a lost decade for the equity market. We may do. But I'm not saying we're going to. And I reiterate, over long periods of time, you need to be in the market. Okay. So markets, uncertain, maybe haven't bottomed, but stick with it. It's going to be a bit of a ride. So this is what I really want to talk about. I'm not going to cover all of these things, because I want to chat to Gugu in a minute about various things. So I've only got 10 minutes to cover this. This is the shift that's happening, okay? There's three main shifts, in my opinion. One is economic, second is geopolitical, and the third is technology. On the economics front, we are going, I think I'm pretty confident in this, from low inflation to high inflation, from low interest rates to high interest rates. And I'll tell you why in a second. On geopolitics, and again, we've spoken a lot about this, the shift of power from the west to the east, from America to China. And we're seeing it in front of our eyes on the television. The power of US is diminishing. Joe Biden, bless him, has just, I'm glad he's still upright has just spent, how many days did he spend in Saudi Arabia? 3 days, I think? The golfers aren't allowed to accept the money, but Joe can go there. It's all cool. And he spent 3 days in Saudi trying to get some oil. They said, no, we're not going to do it for you. The US has no power anymore. China, meanwhile, is strutting the world stage quite happily. So that shift is happening. I've talked about that a lot in the past. I'm not going to talk about it much today. The third one is technology, which again I've talked quite a bit about. And whilst all this stuff is going on, the next decade is going to be the decade of technology and exponential growth in technological themes. I'll come back on a couple of those in a second. I'm going to talk about the inflation thing, and then I'll wrap up with how we can best profit from these themes, okay? Because the world is changing. So this chart has I think, a misleading headline, or maybe an informative one. This is from the Financial Times, I think. Long-term shift in inflation. This is inflation back to 1880. Except for wartime in the 1970s, inflation tends to be low. That is true. But I think we're going back to more like the 1970s. So in the 1970s, the Fed made a very similar mistake to what it's making now. It kept rates too low for far too long whilst inflation was going up. We also had the oil price spike in the 1970s. Social unrest, strikes, wage demands, ringing any bells? It's happening again. Oil price spikes, social unrest, strikes, wage demands. And the Fed is way behind the curve. It held rates low for way too long. And to compound its error, it printed $9 trillion worth of cash, which is 30% of US GDP, and pushed it into the economy in the last decade. That is a catastrophic error. And it'll come to be seen as such, I think, in years to come. And if you print too much money, what happens? You get inflation, because there's too much money around. The price of money goes down. That's just the way the world works. So the Fed's made a big mistake, and we're heading for probably not as bad as the 1970s. And I think as a headline, inflation will come down from 8-ish to kind of 4-ish, but it won't go back to 2. We've had 2 for 40 years. I think this chart is quite informative in terms of what might happen. Okay. Countries on the left. Central bank rate in the third column, so that's the interest rate. So Denmark is minus 0.6. Eurozone is minus 0.5. Okay? Look at the Eurozone. Next to the minus 0.5, CPI 8.1. That's not the right thing. That shouldn't be happening. The next chart is inflation less the interest rate, for those who can't do the maths. And they're all, inflation's always higher than the interest rate. What are people doing? They're hiking. But the point about this chart is that everywhere across the world, people are way behind the curve. And when we say behind the curve, we're saying we haven't dealt with inflation properly with interest rates, and that's going to happen now. Turkey, by the way, at the bottom, can you see that? 14% interest rates, 73% inflation. Well done, Erdogan. That's what happens when your government takes on your central bank and an autocratic state. So rates have a long way to rise. And the final kind of warning sign, I think, the final shoe to drop, I think, will be house prices. Possibly not in South Africa, because again, it's very cheap in South Africa, still relative to global. But you need to be in the right places in South Africa. But globally, this is US house price inflation. And you can see how extended it's become. House prices have had their own little bubble. Canada, New Zealand, Australia, the States, UK, London. I was in London a month ago. Oh my goodness me. I mean, it was like party town. Everyone's making money out of property again. It was insane. Because the Russians are gone, but the Americans are in town because they're traveling again. They're all buying property in Mayfair. It's crazy. So that's the bubble that's next going to burst because rates are going to be higher. Just the way maths is. Okay. So, where to win in this, if we're right? And CB will cover the implications of higher inflation in South Africa. By the way, disclaimer here. The best solution always for you and your clients, in our opinion, and I think it's the right opinion, is a multi-asset fund. A balanced fund, which has all these assets in it. And we can make these kinds of calls within that. Okay? But if you want some kind of interesting stuff on the side and things to talk about, these are important. Inflation hedges, gold. Real assets, infrastructure, forestry, for example, and maybe even real estate once it's kind of deflated, and index-linked bonds. Renewables, and I'm going to go on from the inflation theme into the other themes. Renewables, solar, wind, and hydro. And what's going to happen here? These two top ones, by the way, just flick down to the fifth one down, tokenized ownership. Just a touch on the tech thing. Some friends were at the NFT, non-fungible token, conference in New York City 2 weeks ago. There were 15,000 exhibitors. It was mayhem. So NFTs, Metaverse, Web 3.0 is happening. The prices have deflated, of course, but it's happening. And one of the biggest impacts is going to be tokenization. Okay? So you'll be able to own, I don't know, 1/10,000th or 100,000th of your favorite F1 team. Or the Cape Town Stadium. Anything you can see, digital or real, you'll be able to own a piece of it. Right now, we can buy those kinds of things for our institutional clients because you put 100 million into it. But for us ordinary investors, we will be able to own slices of things. Everything will become tokenized. And they can do that because of blockchain technology. So blockchain as the underpin will provide this tokenization so you can buy infrastructure and forestry and a solar farm and a wind farm, a sliver of it. That'll be an important asset class to protect you from inflation. And accelerate to the end. Google, you're on in like 2 minutes. Exponential technology, we were trying to time the launch of our Applied Intelligence Fund at Old Mutual, which will capture all of the global technology trends we've been talking about in previous talks. We're trying to time it for when the technology bubble burst. So we're going to launch that fund towards the end of this year, maybe early next year, which will give you access to all the exponential tech trends I've been talking about. China dominance, we talked about that. Ethereum, bless it, it kind of came down quite a long way again. That's my go-to. If you believe in the metaverse, if you believe in NFTs, the underpin is Ethereum. Opportunity. And then just finally to close, the big hope one is that our children, certainly our children's children, will live to at least 150, and some will have the option to live forever. Is that scary for you? Do you know your children too well? You don't want them around that long. So life longevity is going to be a big theme, but you have to be in a wealthy country and be relatively wealthy. Because the correlation of high healthcare spend per capita and high GDP per capita, it's very linked to your ability to live for long periods of time. So if you live in America, on average you live to 80 now, 80. If you live in Angola, you'd be lucky to live to 60. That's a 20-year delta. So that's going to be a big theme, and you can capture that through global healthcare and through the Applied Intelligence Fund.